Are people going to get so desperate financially, meaning they're out of cash, they've lost their jobs, they're stressed out, they can't make their mortgage payment, or they had a variable rate and they can't make that payment? Are we going to get to that point where there's enough people that get into that position that now they have to fire sell their house just to get out of the debt burden? And that's what we really haven't seen yet.
We're talking about the largest asset class in the world, real estate, if you count up all the properties globally, but we're focusing on U.S. real estate today. And it's a very important market because it impacts everybody, whether you're a current homeowner, a potential buyer, or a renter. The direction of home prices will dictate not just your bottom line, but also your consumption, spending patterns, and even your psychology, some may argue. So helping us understand this market is Briton Hill, an expert on real estate. He is the managing partner of Providence Lending, and we'll be talking about which markets aren't doing so well, which housing markets may boom, and if you're an investor, how to pick real estate investments and what to look for when deciding on which market to go into. Before we begin, comment below on where you see the real estate markets overall in the U.S. headed, and which cities and which types of housing you think will do the best over the coming years in our current macroeconomic environment. Briton, welcome to my show, The David Lynn Report. Pleasure to host you today.
David, happy to be here. Congratulations on the new show.
Thank you. Briton, I've spoken to you for a while. You're a hedge fund manager. You've moved around funds for a bit, but you've always been an expert on real estate, which is why I've brought you here to talk about this asset class that's so important to everybody. Let's talk about the broad overview first. Now, we've got a lot of prominent investors speaking out against real estate, or voicing their concerns. Charlie Munger, for example, spoke to the Financial Times recently, and he's concerned about the commercial property market overall. Let's talk about that market first. So Charlie Munger, his words, he said, it's not nearly as bad as it was in 2008, but trouble happens to banking just like trouble happens everywhere else. He says that a lot of real estate isn't so good anymore. We have a lot of troubled office buildings, a lot of troubled shopping centers, a lot of troubled other properties. There's a lot of agony out there. So that's one viewpoint. But then everywhere I see, and whenever I visit Miami or New York or even Canada and downtown Toronto and Vancouver, there's skyscrapers going up. So I'm getting both sides of the picture. Where do you stand?
It's a good question, David. The key to real estate is where you are and what's happening where you are, because so much of it is just locally driven by what the local economy is doing. And so commercial real estate in general is facing several headwinds right now. The first one, obviously, is rising interest rates and inflation. That's just destroying the cap rates. So at the end of the day, investors aren't making as much money. And, if you have to lock in a higher interest rate now, you have to bring down the property value, assuming that you have fixed rents, in order to match what the person is going to pay in interest. So that's a big headwind right there. The next thing is, even though people are going back to work, there's still an overall downtrend for commercial space use, because commercial space doesn't only include offices, but it also includes retail. And a lot of retailers are just going to more of a drop shipping warehouse type of model. So I think that in the commercial space, some areas that you'll see do well are warehouse space, because those are going to be needed. But I think that overall retail space is going to struggle across the board. And that's not everywhere, of course. There will be areas where retail space is a premium, certainly like Miami, South Florida, and in Toronto, other areas that you've spoken of. But across the board, I think that commercial real estate is an area that's going to continue to struggle and lag overall.
But why is that? I mean, I've had the same concern from other guests as well. But why is that? You would assume that people going back to the office would make it another hot commodity, no?
Yeah, absolutely. And that's why you're still seeing skyscrapers going up in the big cities. I mean, corporate office space is still going to be in demand, I think, in big cities and big metro areas. But I think the big thing is, when you're talking commercial space, you're talking about it as a whole. First and foremost, real estate is just struggling in general with rising interest rates. And then you have the decline in retail space and just overall need, because even though a lot of people are going back to the office, there's so many industries that just never went back. I mean, I know a lot of my friends that work in finance or even tech, they just decided to stay remote. They trimmed back the number of office spaces they needed, and they just don't use as much as they did. It was a cost-cutting measure that is needed now more than ever, especially with how the economy is.
Do you think that higher interest rates this year versus last year or even 2 years ago are going to force out a lot of businesses from the cities, meaning that they can't afford rent anymore, or maybe their property taxes are just going up to the extent that they have to foreclose their property and just move everything online and work from home. Is that happening right now?
Yes. Businesses obviously have more capital than individuals to kind of wait these sort of things out. But I think that businesses will be under more pressure in the long run than individuals and people, that are just looking for residences. And the reason being is you see a lot of these subsidies and programs coming up to help people find affordable housing. And it's the same thing that happened all during the 70s, 80s, and even into the 90s, where interest rates were so high and inflation was so high that housing became totally unaffordable for the majority of people. And so the government came out with all sorts of programs to help subsidize or offer incentives, tax breaks, things like that. And we're already seeing that in the US, where people with subprime credit scores now get a reduction on their interest rate, and it's almost punishing people with good credit scores. But it's kind of backwards, but you gotta think that the alternative is homelessness, mass homelessness, because people can't afford housing. So I think that we'll see a lot of programs roll out for residential, where commercial, I don't know, there's not as much empathy for big business. So I could see a lot of big businesses have to shut their doors, move out into the suburbs, find cheaper space, or just scale back and push people remote like they were during the pandemic.
Tell us about your own experiences, Providence Lending. I know you work in the real estate sector. What's it like over there in Utah, where you're based? Are people still buying up commercial property? Are you seeing a lot of lending activity? Tell us about your experiences and how your fund works.
Well, as a private hedge fund and private lending group, we have been inundated with loan requests, and it's mostly because of banks. Banks just are not lending anymore. And so private lenders and private lending activity has just ticked up dramatically. So not only are our returns very strong, but we have just pick of the litter. For every dollar we have in the fund, we have $1 million trying to get at it for just a loan, because banks aren't lending. So I think there's still a lot of real estate activity. The big change that we're seeing and the shift that we're seeing is banks aren't facilitating it as much as they used to. And so real estate investors are having to get very creative. Now, Utah and the Mountain West in general, we have pretty severe winters. And this was one of the harshest winters on record, at least in Utah. So we saw a kind of a triple combination of interest rates are through the roof, prices are through the roof, and now nobody wants to get up and move during, blizzards upon blizzards. So our market came to a halt, and it was really interesting to see, things boom, 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 and then all of a sudden just grind to a halt. But now that it's getting sunny again, we're starting to see things pick up a little bit in the residential side. The commercial side it's hairy. I wouldn't want to be a commercial real estate owner in Utah unless it was manufactured type buildings, warehouse buildings, things like that for shipping and storage.
Things ground to a halt because there was no demand for commercial real estate. We'll talk about residential in just a bit, but there was no demand for office space, or there's no inventory, or what was happening there?
I think it was pricing. I think everybody was shocked with how quickly interest rates rose, and it just made payments completely unattainable. And so you have these landlords now, or prospective landlords, who want to purchase properties, but their costs have gone up tremendously. And so they need to raise their rents. And you have these people who their incomes haven't necessarily gone up. So they're faced with higher rents of what might be discretionary commercial space, and the big thought process is, do I really need an office? Do we really need this much space? And so it's made things a lot harder for commercial property owners in general. I think that's across the board, but Utah, especially, just with the weather and everything like that, a lot of people wait until spring or summer to do anything moving wise.
Okay. So I guess it's becoming sunny, both in terms of weather, figuratively speaking, and literally speaking. Talking about the economy. So we'll get to that. Now, let's talk about the banks, because you mentioned something very key, which is that banks are lending less. Now, the theme right now in the capital markets is, of course, the regional banks being in trouble. As you know, over the weekend, First Republic Bank was seized by the government, and the assets were sold to JP Morgan. And so, first of all, two-part question. Do you think that this trend will continue, where more regional banks may suffer, collapse, and be bought out, or perhaps this is going to be okay? And second part, what do you think is going to happen to the the lending market now that we've had this banking crisis that is still unfolding?
That's the big question that everybody has right now. I'd like to say that we've seen the worst. However, you have bad balance sheets for most banks. And the reason why they're bad balance sheets is because they haven't marked their assets to the new appraised value. They're still holding their assets on their books at the 2021 value. And the issue that a lot of these banks would have is if they reappraise those assets, I think a lot of them would be underwater. And it's the problem that all of those banks, Silicon Valley Bank, Signature Bank, and First Republic Bank all had these issues of just bad assets. And it's not that they're bad assets, it's just they're assets that were worth a lot less than they were 2 years ago. And so I think that if we saw banks starting to mark their book values to what those assets are today, we could see a lot of pressure, especially on smaller, more regional banks. Now, I think that the Federal Reserve and the federal government are going to do everything they can to try to prop up the banking system, because that's literally the core of our financial system as we know it. But it's a perilous time, especially for banks. The good news is depositors have been made whole and depositors are okay. I would not want to be a shareholder or a bondholder of a bank right now in any way. But that doesn't mean I'll always feel like that. Obviously, I think times like this create tremendous opportunity, and I think we'll see a good opportunity to purchase banks, especially bank stocks, in the future.
Right. So if you're a business owner and you need property, what are the lending options that you have? Besides businesses
Sure.
like yours.
Well, the biggest thing, we're a short-term bridge lender. So banks will loan and will still extend credit, but the process is just far longer. And so a lot of the times, there are some good deals starting to pop up on the market, especially with the downside pressure. And there's still people with a lot of cash. So we help the non-cash buyer compete with potential cash buyers we can do a close in as little as 72 hours, assuming everything is lined up. And, we'll do a 6-month to a 1-year term. And we're just a lien holder on the property, just like your traditional bank would be. And what that does is that gives a potential property owner or a contractor the opportunity to lock in the property and then work on refinancing us out with a bank. The big thing we're doing right now, though, is construction loans. A lot of banks aren't funding the draws anymore for the construction loans. So you have these projects that are 80% of the way done, and these contractors are calling the bank and saying, hey, I need another draw to pay this subcontractor or to buy lumber or whatever. And the banks are just flat out saying, sorry, no, we're not doing it. We're not paying any more draws. And so these contractors are really stuck. And we've been, I think, a key player in helping move the real estate economy along a little bit here in the area, simply by helping those projects be completed and providing some liquidity where it's desperately needed.
Hey, speaking of lumber prices, since you brought that up, I'm looking at the chart. The lumber price has collapsed since last year. It was like 5 times, 6 times higher than it is now. I'll put a chart up on the screen. And so, first of all, why do you think that is? And second, how do you think this is going to impact home pricing? And we'll talk about home pricing next.
Sure. Well, demand has plummeted. I mean, home builders especially have halted home building just because interest rates were so high and it was very tricky. So I think that the price of new builds I wouldn't necessarily say come down, because it rarely comes down, but I think it definitely won't be increasing as rapidly as it has been across the board, simply because the base materials don't justify those costs. I mean, if you can get lumber for 5 or 6 times cheaper than you could a couple of years ago, somebody's going to be willing to compete at a lower price point based on that lower price of materials. So we'll have to see. But what I've heard from a lot of my friends who are contractors and the contractors we've worked with, even though the raw materials are only priced at that level, a lot of suppliers are still commanding pretty high prices. So it has yet to work its way all the way through and trickle down to the contractors and the builders. But I think it is slowly starting to move that direction, and we could see the price of new builds come down.
The cost of your renovations is gonna come down as well, right? So that might be
absolutely.
So, bottom line, before we move on to the residential market, would you buy a commercial REIT as an investment right now?
I can't say I would in general. I'd want to avoid commercial REITs. I would even hesitate to be heavy on the real estate equity side, unless you're an experienced investor and experienced contractor. I much prefer to be on the debt side, because as a debt player, We get consistent income from our interest revenue, and our investors get consistent income from that. Worst case scenario, if the borrower doesn't pay us back, we have a great property, an investment grade property. Most of them are producing income that we can, take over in a foreclosure at a 60% loan to value, which means for every $1 million of appraised value that property has, we're only loaning 600 to 650,000. So we have a lot of cushion, and we're well protected. I much prefer debt right now to equity.
Okay, we'll talk about your fund towards the end, but for now, if people want to do it themselves, most people can't participate in the debt side, but they can indirectly get fixed income, or I guess directly get fixed income if they purchase a property, condo, house, whatever the case may be, and rent it out. And so let's talk about the housing, the residential housing market now. The U.S. S&P 500 Case-Shiller Home Price Index, which is an index the major cities in the U.S., and a basket of residential housing in those cities, that's been rolling over. And if you overlay the chart of what's happening now to 2007, it looks identical to actually the start of 2007. You'll recall that the housing price actually started dropping before the 2008 financial crisis. The home price index was already dropping before Lehman collapsed. So I want to ask you, based on your experience and what you've observed, Briton, do you think that the residential housing market is a leading indicator of a recession?
I certainly do, because that's the American dream right there. That's what people kind of aspire to. And if you see house prices falling, it means your average consumer is not purchasing homes, and people that own homes are having to lower the prices of their homes in order to get out of them. So, housing is up there with the base needs of every human. And so when you start to see those prices fall, I definitely think that's a leading indicator to a recession. And, nobody wants to admit it, but I think that we're in a recessionary period now.
Just on that, why do you think we're in a recessionary period now? It's not officially on by government decree a recession yet, but why do you think we're in a downturn now?
Well, it's easy. By definition, a recession was 2 quarters of falling GDP activity. And we had that last year. And what did we do? We just changed the definition, and it was actually quite hilarious. I'll send you this after so you can post it up. But there was a FINRA test I was taking, a regulatory exam, and the question was, how many quarters? And then this was right after Biden or whoever changed the definition, and it said, how many quarters of falling GDP activity do you need to have before you have a recession? And I looked at it and I said, well, I don't know anymore. And it was by FINRA's definition 2 quarters, but they changed the definition on us, so now nobody knows. But by the old definition, we are or were in a recession, but nobody wants to admit it. And even the regulatory exams they're making financial professionals were indicating that, yeah, we're in a recession. So it's just a big confusing mess. I think that most people would agree times are tougher financially than they have been.
But by the way, just on that note, in 2020, there was officially a recession, but there was only 1 quarter of negative GDP growth.
So nobody knows how to define it. I think if for over a year you have made, no significant lifestyle spending increases, but you're still feeling tight on money, and, things are getting more expensive and it's hard to make ends meet, and you're feeling financial stress and you're worried about your job security in future because there's mass layoffs happening everywhere. To me, that screams times are tough economically and we might be in a recession, but what do I know? I don't make
you know quite a bit, which is why we have you on. But thanks for that insight. Okay, so going back to the house price index, you told me offline it is the housing market's very, very diversified. So we'll talk about specific markets, but overall, the index measures the national average overall. It's been rolling over. If you look at it on a percentage change basis, it's still positive. So not the house price index as a nominal term has been coming down, but it's gone up so much in the last 2 years that relative to a year ago, it's still up. So if you bought a house 2 years ago, you're still making money. If you bought a house a year ago, technically you're still up. But do you think this trend is going to continue, and it's going to come to a point where people who bought in the last 2 to 3, even 3 years are going to be underwater?
It really depends on where you're at. There are some areas that have struggled, like Las Vegas, for example, has struggled last year. We've been shopping that market for quite some time, both as an investor and personally, to get a personal residence down there. And we've seen those house prices come down dramatically. But the bigger thing is all the realtors we've talked to are saying that there's incredibly low inventory. And I was kind of perplexed. That's interesting. And the reason being is people that own the houses know that they can't get what they bought it for. So they don't want to sell. Nobody wants to take the loss. And on the buying side, nobody really wants to pay more than what it's worth. But the biggest thing is I think current homeowners are just holding. They've got lower interest rates. They know that if they sell their house, they're going to have to go buy something else at a higher rate. And they really, at the end of the day, they don't want to take that loss. So I don't know if every area has fully seen the effects of this real estate type of crash, because nobody has gotten so desperate that they needed to sell. And I think that's going to be the underlying factor. Are people going to get so desperate financially, meaning they're out of cash, they've lost their jobs, they're stressed out, they can't make their mortgage payment, or they had a variable rate and they can't make that payment? Are we going to get to that point where there's enough people that get into that position that now they have to fire sell their house just to get out of the debt burden? And that's what we really haven't seen yet. Even though the real estate market's been affected, it's mostly just affecting the new home buyers, people that already are locked in, they're comfortable, they have a low interest rate, their payments are low, and they can make those payments. I think what we're more likely to see is people that are buying now over the last year or two that have interest rates 2 to 3 times higher and payments that are, quite a bit higher. They're going to struggle to make those payments if things go south on them. So I think over the next year, we'll really get an idea of what's going to happen. But again, I think it's going to be pretty specific on where you're at in the world, what area you're in, and what interest rate you got and what prices you're able to lock in.
People often cite the fact that in prior years, the interest rate was much, much higher. And so, why should people be concerned now if the interest rate isn't, it's gone up since last year, but it's still not as high as historical standards. But you've got to remember that the average home price has also gone up a lot more. So your total interest expense as a percentage of your income has gone up a lot more. So my question is, to your point, do you think it's already at a point where it's unaffordable for a lot of people?
Yeah, absolutely. I mean, if it wasn't, nobody would be complaining about it. At the end of the day, housing is always going to be difficult for some number of people to obtain. But I think we're seeing far more people now struggle with it than we ever have in the past. In the early 80s, mortgage rates hit high teens, and that was just normal for them. But, you could also buy a house for a candy bar back then. They were so much cheaper, where now, even condos, 1-bedroom condos in certain cities are over $1 million. And, a 1-bedroom condo used to be just a, young single person working in the city, what they would own and rent. And now it's like, geez, you have to be a major professional in your field, making a lot of money to even afford a very basic dwelling unit. And so I think that housing it's more expensive now than it ever has been, even though interest rates aren't as high as they have been. The house prices in general, because the prices of house increases have dramatically outperformed and outpaced what wage and typical wage increases have been. So we either need to see house prices stagnate and wages catch up, or house prices fall, and one of the two. I think they're more likely to stagnate because of programs that the government is going to implement to prop houses up, but it remains to be seen.
So what you told me about the realtor story about inventory being low relative to what it was is supported by the data. I'll put up a chart showing St. Louis Fed data, again, national average housing inventory pending listing count in the U.S. It's come down tremendously. So the count of the definition here is a count of pending listings in a given market during the specified month. Has that come down because people are just unwilling to sell, or people there aren't as many new homes being built?
Both. There's definitely a dramatic decrease in the number of new homes being built. In our area, it's driven by the market and the weather. We'll see what happens this spring now that the land has thawed out and builders are getting back to building. But I think that it's a combination of, oh, shoot, I don't know if I can get out of my house what I put into it, especially considering a lot of people remodeled their current homes during the pandemic because we're stuck at home. We have nothing else to do. We might as well fix the kitchen. So you have a lot of people that invested into their residences that now don't want to sell. And also you have builders who have ceased building activity because the prices of new homes were so expensive, especially when you couple that with interest rates.
It's remarkable how you're right. A lot of people didn't want to sell 2 years ago when prices were at all-time highs. The price has come down, like I said, but you would think that when your home price goes up 40% in 2 years, I guess it's time to sell if you're an investor, but that's not the case. What was going on in people's minds, you think?
Well, most people are homeowners and not investors. And I was kind of stuck between the rock and a hard place at that time where my lease was coming up and I didn't want to renew my lease, but I wanted to buy a house. And so I had to build a house. It was tremendously expensive and I built it. But housing is a need. And when you're faced with, okay, yeah, my house has risen 40%. This is great. I've made a lot of money, but every other house I've wanted to buy is up 40%. If I can find one that I like as much as the one I'm in now, it's kind of a wash. Housing is one of those things where for a homeowner, unless you're really upgrading and upsizing, it's just kind of a wash because especially if you're staying in the same area, everybody else's house has risen just as much as your house has risen. And so you don't see a lot of that type of selling activity because especially to time it, if I sold my house up 40%, what am I going to do in the interim until I hope it comes down? Maybe it will, maybe it won't. But at the end of the day, I need housing. And, most people just sit on their houses and they're happy to know that they've made money on it. But that money is sectioned off for more housing.
So let's talk about individual markets. The CNBC article that I'm reading that came out in February, it's titled "The 15 U.S. Cities Where Home Prices Are Growing the Fastest." None of them are in California or in New York. So I'll show the list on the screen. I'll put the link in the article. People can check it out. Farmington, New Mexico is number one, grew 20% in 2022. And then you have a few cities in Florida, North Carolina, South Carolina, Wisconsin, North Carolina, Texas, and more Florida, and so on. Now, it says later down the article, a number of factors contribute to this. Working from home, remote work. Some of these cities are good for retirement. Suburbs did well during the pandemic, so that's a continuation of that. Generally speaking, Briton, if you were to pick a home as an investment, not as a primary residence, because that obviously depends on where you live, but if you were to pick a home for an investment, which areas would you target right now and why? What indicators would you look for growth, basically?
The first thing I'd look at really is what are the home prices relative to the average incomes in the area. And you find that home prices are most affordable relative to incomes in the Midwest and the Southeast. And so it doesn't surprise me that a lot of those names on that list you just said are states that are in the Southeast, Midwest, Texas, North Carolina, Florida, because with exception, there's some metro areas that are wildly expensive and just massively overpriced anywhere you go. But in general, I think that those states have really good, affordable housing relative to a lot of areas and incomes to support paying those prices. And so I would be an investor in those areas. And that's actually where we're targeting, especially if you can get really affordable homes for a good price in areas that have a lot of low income individuals that need Section 8 help, because the Housing Authority, HUD, is desperate for landlords that were willing to do Section 8 properties, which means you contract with them and they're willing to pay a pretty solid premium on rents, and it's government guaranteed rent. So there's a lot of avenues you can go. You can find a good middle class area, or you can focus on a low income area where the Housing Authority is willing to work with you as an investor.
And what about for capital appreciation? If you're just interested in capital appreciation, do you see areas that will see tremendous growth over the next coming years, and why?
Yeah, absolutely. I think that Texas is a great area, especially Austin suburbs. You have a lot of really big companies moving out there. You've got like Samsung that's building a massive plant. Maybe it was Sony. It was either Samsung or Sony, but then SpaceX is out there building a massive plant. And you have a lot of these companies that are being incentivized to come out there. And, Austin, I know, has appreciated rapidly as far as the city goes, but the suburbs, it's still pretty undeveloped. And so there's a lot of opportunity out there to invest. And I think there's even some good crowdfunding platforms that if you're a small investor, you don't want to go out there and have to buy land and develop something, where you can just find some of these crowdfunding platforms and place a small investment into development projects that are happening out in that area.
Okay, great. And finally, Briton, talk about your fund. So Providence Lending, as the name suggests, you're in the lending market. How does your fund work?
Sure. Again, to reiterate, we're a short-term lender, 6 to 12 month term as far as lending goes, and we always make sure we have the properties as collateral. Lately, we've been focusing pretty heavy on income-producing properties, so that way, if there is a borrower default, worst case scenario, we recover that with an income property. So we just trade interest for rents, which has been nice. Fortunately, we haven't had a single foreclosure. We underwrite very well. We've never had to foreclose on a borrower, and we work well with our borrowers from a borrowing standpoint. From an investor standpoint, we returned 9.3% last year. We beat the S&P by almost 30%, and those are audited financials. And that was between April 15th and December 31st. So that wasn't even a full year of data. This year, we're up between 4 and 5%, and we're targeting over 1% per month in growth and interest income. And then we distribute that quarterly to our investors. So for investors looking for a good income product, you can figure 1% per month. That's all after fees, net of everything and expenses. And you'll just get that wired to your bank account every quarter. Unless you want to reinvest, you can take advantage of some great compounding. But I think from an investment standpoint, being a lender right now where nobody has cash and cash is king is probably the best investment you can make, because everybody needs cash and banks aren't willing to divvy it out. So if you can become a private lender and get involved with that, it'll do very well for you.
And is this open to all types of investors? What's the
accredited investors? So you need to be an accredited investor, $250,000 a year in income or $1 million net worth, excluding your primary residence.
All right, I understand. All right, Briton, thanks very much for your input and your insights on the real estate market. Important market for everybody, like I said, so it's good to understand a little bit more. Thank you.
Absolutely. Thanks, David.
And thank you for watching the David Lim Report. Stay tuned for more, and don't forget to subscribe.